Hello and welcome to Options Guy TV. My name is Brian Overby. I'm the author of the Options Playbook. And we're still in the heart of this quarter's earnings season. We have one of the biggest companies that really I don't know if anybody in this world that has a 401k or some type of retirement account has the ability to not have Apple in their account. It's in every single index that is out there. There's any type of management portfolio, they seem to have some shares of Apple in their account. And Apple's going to be announcing earnings Thursday after the close. So today's show is really going to be a lot about Apple. We're going to look at a trade that we did back in October. That was a hedge trade going into October, a little nervous about Apple. That actually gave us some protection. We actually looked at a collar in Apple, and we're going to review how that trade is working out. And then, since we have earnings, we're going to do one that's going to be specific. We're going to do a protection strategy that's going to be specific to an earnings report. Now, you can apply it to any underlying stock that you would like to apply it to, but overall, the general feeling of Apple, considering what's going on with China, labor concerns, battling between the governments, and just general nervousness about where Apple is at. Even though it is, like I've mentioned at the top of the show, probably owned by almost anybody that has some type of retirement account, unknowingly in some cases. But there's a very high probability that you have at least a smidgen of shares or exposure to Apple if in any type of portfolio that is in regards to retirement. So still a little bit bullish, but nervous in Apple. And that's the way I feel like I hear a lot of the pundits that are talking about Apple. Long term, almost everybody is bullish on Apple. Short term, nervous, considering all the little things that are happening in Apple. So going into earnings, we're going to do another protection strategy. It's going to be centered around owning 100 shares or more of stock, but we'll do it based on a 100 share basis. And we'll look at the trade that we entered a while back on Apple. That was a collar going into October, and that was mainly because of October. We went out beyond the November earnings. So the expiration is actually the 17th of November. So that trade, in theory, even though it was in paper, it was considered a paper trade, is still live and still rocking and rolling. And so we'll look at where that is at, and then we'll come back and also look at a protection strategy just for this earnings reports. But before we get there, I have to make a correction. The other day, we talked about an earnings report in Marathon Oil. Well, it turns out that Marathon Oil, what I saw on the earnings whisper was Marathon Petroleum. And this is a rookie mistake, and I've done it before, where Marathon Oil and Marathon Petroleum basically split up about, I think it was about 2011. And they always announce earnings together. Both of the companies' names start with Marathon, and Marathon Petroleum was the company that was announcing earnings recently. Well, I guess it was yesterday on the open. It's actually doing quite well. Marathon Petroleum is up 3.65% right now, trading at 572. Had a decent day yesterday. So in general, that earnings report has done well for the stock. Marathon Oil, MRO, is the underlying that we looked up at setting up that trade on. And so I'm going to type in Marathon Oil, and I'm going to do an adjustment to the trade because Marathon MRO is announcing earnings this week too. And both companies are usually announced within a day or two. And Yahoo Finance actually had the date wrong. They had it as November 1st. So I finally went to the source, and I went to Marathon Oil and went to their investor relations. And it turns out that they're announcing November 2nd before the open. So it hasn't happened yet, but it still does have, as far as the options are concerned, we still do have the pump up in implied volatility and the skewing as we went back. So we did look at that on the show, and it did show that we had the high implied volatility and the skew, so implying that there is earnings coming this week. It just wasn't on the 1st. It's now going to be, or it wasn't on the 31st, which was when MPC announced earnings. It's now going to be on November 2nd. Okay, so the trade's done well. Better to be lucky than good, right? So here's the trade that we looked at and we set up on Monday. We bought the 26 strike call in MRO. The underlying stock was let me check right here where I was at in that 2709 is where the underlying stock was at when we put it on. So we're up 40 cents on a $27 stock. That's not a bad move. Right now it's up, it looks like 0.5%, up 18 cents on the day. And that probably has a little bit to do with the movement in MPC, Marathon Petroleum Company. And with that mentioned, with the underlying, that long call spread that we did, which is we bought the 26 strike call and then we sold the 28 strike call. And in that instance, we one second. Let's pan out just for a second. Let me see why am I having this issue? All right, 1 second. There we go. All right, let's go back. I got rid of the banner. Okay, so we bought the 26 strike call and we sold the 28. The stock was at 27 at the time, and it was real nice because we really wanted to straddle the market, and we went into great detail about the fact that we wanted to be buying as much time premium as we're selling. And this is actually a real good learning experience. We had the movement up about 50 cents. We were hoping that it would move $1 going into the earnings, and it still could. I mean, we're still looking fairly good on this trade. We put it on for $1. Talked a lot about why it was $1. It's a 2-point wide spread. We put it on for $1, and that's usually the case when you are straddling the stock price. You're going 1 point in the money, 1 point out of the money. And we focused on the intrinsic value. So when we did that, we bought almost as much. Well, actually, it would have been extremely close because we paid $1.04 for that. So it was really close to buying just as much time premium as we were selling. So in this instance now, we see on the 26 strike call, the extrinsic or time value is down to 12 cents using the options grid. And the extrinsic or out of the money value on the one that we sold is at 33 cents. Now, we are up a quarter on the trade, or if we put it on for 104, then we'd be up 21 cents, which on a percentage basis is good, but we only looked on it on a 1-by-1 long call spread. So if we look at that trade, we are up on the trade. Why aren't we up as much as we might hope? It's because implied volatility is still at 63% because they have not announced earnings at this point in time, and we did not get that volatility crunch. So we're not getting rewarded quite as much as you would expect because we still got to buy this option back, and there's still a ton of premium in it. We're close to the at-the-money option. It's trading at a 33. Well, basically, whatever the quote is the time value because it's out of the money. But that is why this is not paying out. So let's adjust the trade. We made money on this trade per se. We'd just close that out, move on, because we were really thinking that we should have been doing it in MPC, but I'd rather be in Marathon Oil. I'd rather trade that underlying stock anyways. But bottom line is that's what happened. Okay, so let's adjust it. So I'm just going to clear this out, and we're going to put on a new trade. And then when we come back the next time on Options Guide TV, we will talk about the new trade that we put on, which is actually going to be this coming up Monday will be the next time before we get to look at this trade. This Friday, I'll be traveling, and we have a special show for you about the Greeks. We'll talk about Delta and Gamma on Friday's show. All right, here we go. So now we are at 27.46. So let's go a little bit wider. Since we are at the money option is 27.5. If we can do the 26 and 29, I like that. Okay, so we have 50-cent strikes in here. And so we're going to now, why not? Let's change it up a little bit. We have a little bit different offerings because we have the half-point strikes that are surrounding the underlying stock now. So we're going to go 1.5 points in the money and 1.5 points out of the money. So right here we have the 26 strike. Let's buy that one. Okay. And 2 days remaining. It means we're going to 162 by 156. We're 12 cents in the money. So then we go 29. And once again, very close to since we're going equidistance in and out of the money, notice that the extrinsic value is very close to the extrinsic value of what we're buying. So in here, we're going to sell this one on the bid. All right. And so now the total cost of our trade is $1.48. Makes sense. Go back to Monday's show. We did a 2-point wide trade and we spent $1 for it. Now we're doing a 3-point wide trade and we're going to cut that in half. We're going to spend $1.50 for it. So the laws of option pricing are holding here. And if you're straddling the market and you have a 50-50 chance, basically we're betting $1.50 or investing, but I would say speculating would be a better word to use. $1.48 to be more accurate. Paying $1.48 to try to make $1.52. We are buying the same amount of time premium as we are selling, almost to the penny. And then we're taking out implied volatility, time decay. We're taking all of those factors out and making it all about the price of the underlying. If we look at where the potential move is with 2 days remaining, we actually see that it's at about $1.10 here. So the expected move is about $1.10. We're looking for $1.50 is what our ideal move would be in this situation. And in that instance, we're going up to 29 on the upside. And so let's actually do the math on that. So if we got the long calls that we'll call that 50 and we'll call that 55. So we're at $1.05 divided by 27.50. The expected move to buy this thing is about 4%. And interesting enough, MPC is up 3.5% actually today, staring over here on this side. Just interesting how all the math kind of works out in the options trading world. So that's going to be the adjustment to our paper trade for Monday. And I'll make note of this and we'll see what happens after their earnings on the open on November 2nd. And finally, that implied volatility will come back down and we'll be able to learn what happened with the trade. It'll be interesting. Now let's get into Apple. Okay, so if you have any questions, just want to make sure if you're in the YouTube platform, you can put it in the chat box. We will try to address any questions during the show. It can be about MRO, be about Apple, or any particular underlying that you may want to talk about. If it applies to the show, we'll go and try to address it. But this week, we're going to look at Apple. And we're going to start by, if you look in the description, there is a link to the previous show that we did on October 6th, where we looked at a collar on Apple. And Apple has been down since that date. On that day, the underlying stock was trading right around 175. I think that's where we were at when we looked at that. And now we see that it is, let me see where I got my note on it. Now we see that it's trading at 171. So on that collar position that we did, we went out to November 17th. We put it on October 6th. That was a paper trade. As always, everything we're just kind of addressing. You were pretending that you had 100 shares of stock in your portfolio. We bought a put below and we sold a call above. That position has now helped us out and we're getting into earnings and we can take that position off. So ideally what we would do there is we would sell the put on the downside, and then we would go on out and we would uh, buy to close the call going into the earnings report, or you can ride it all the way through. And then that allows you to remain long Apple. So the collar protected you during a scary period, which just in general is October, all the way into the earnings. Now, if you didn't put that trade on and you weren't nervous about Apple, or you're just a long-term holder of Apple, this trade, I think, is a little bit more interesting in my mind to just get you through the earnings report. It's a nervous time in the marketplace. So how can I just buy some protection in Apple without capping my upside? If I did the collar trade, if I went through and looked at the collar trade in Apple as protection, the downside is going into earnings. If you did get a gap up, you may be pegged on the call option that you sold because of a big gap up after earnings in Apple. And that would make you a little nervous, because if you've owned Apple for a long time, a lot of people don't want to sell it. You sold the call to help pay for the put on the collar, but most people might not want to actually sell that Apple position. So it's a little bit more of an opportunity cost by doing the collar, as opposed to a outright buying of a put where you're bullish but nervous. But that costs money. The collar that we did back in November didn't cost us anything. It was a zero cost collar. So in this instance now, instead of buying a protective put outright, which is a very simple trade, I own 100 shares of stock, I just go out and buy a protective put, we're going to actually do a long put spread as protection. So this is just an alternative trade, and that's what Options Guy TV is all about, taking the plays from the Options Playbook and applying them to a situation. If I owned Apple and I was nervous about this upcoming earnings report and basically what's going on geopolitically around the world, let alone just with China, if I was nervous about it, instead of buying a put that protects me all the way down from the strike price all the way down to zero, that's a lot of premium that you have to pay for it, especially going into earnings. The way that I would approach it is actually buying a long put spread where I'm buying an option and I'm selling an option against it. And so we're going to do that. If I'm in Apple and we look at the earnings here, we have the implied volatility right now is at 61%, and then it obviously drops off. So it does think that something's going to happen before the November 3rd expiration, at least the options marketplace does, showing you higher implied volatility than the November 10th. I'm going to use the November 10th expiration, and I'm just going to talk about a protected put in a way that if I do the protected put in Apple, first of all, you need to talk about your deductible. How much risk are you willing to take? The underlying stock is at 171.39. If we bought the 170, that means that we could take our stock, our 100 shares in concept, and put it to somebody at 170. That means we'd have $1.33 of risk. Or we could go down to the 167.50. And that would mean that we'd go from 171.34, where the underlying stock is at, down to 167.50. And that would be our risk that we would take on before our insurance policy would apply and allow us to put the stock to somebody at 167.50. And the way to think of this is 100% the way that options were intended to be used, as protection. So if you're buying your car insurance, you very rarely buy the zero deductible insurance policy. Why? Because it's expensive. It would be very expensive to have a zero deductible car insurance policy. So the insurance company usually will say, are you willing to take on the first $500 of risk, first $1,000 of risk? The more risk you're willing to accept up front as a deductible means the lower that your policy is going to be. So that's going to be our first discussion here. which one are we willing to take? And I think we would start at the 167.50. I don't mind doing the 170 because we're just not buying the put outright. If we were buying it outright, I definitely would want to do the 167.50, take on a little bit more deductible and lower my premium from 345 on the ask down to 250 on the ask. That would be my way of just buying the protected put. But we are going to sell an option contract to protect us. So with the stock at 171, 5 points is about almost a 4% move in the underlying stock. So I'm not really nervous about Apple moving, well, more than the expected move to the downside. I'm a little bit nervous about that potential, but I think 5% is going to be the width of the spread. We're going to try to lower the cost as much as possible. So we're going to be buying the 167.50 put option. So that's going to be this is going to be our protection. This is our insurance policy. And then we're going to sell the 162.50. Now, no problem selling the 160. That's bringing in 80 cents. The 162.50 is bringing in $1.20. But that's protecting us from 167.50 down to 162.50, which is a 4% move, about $5 on that underlying. I don't plan on exercising the put. My goal would be to sell the put spread and get out of it. And that's why we're doing a shorter term. We're given 9 days for this trade to work out. Much different than the approach that we had on the collar, which we put back in October. October 6th, I think was the date. And in this instance, then we're going to be buying this put and selling this put. All right. So our cost then went from $2.49 to insure our 100 shares of Apple during this earnings report down to $128. So a very big cost savings, but we only have protection for 5 points from 167.50 down to 162.50. Now, if I'm doing this trade, I'm still bullish on Apple. My best case scenario is that Apple opens up more than $1.28 and basically pays for my insurance and allowed me to stay long that Apple. Now, don't forget, we're considering that we have 100 shares of Apple or more inside our portfolio, but we're looking to protect 100 shares of the underlying stock going into earnings. So you're treating this just like you would your car insurance, in that most people that buy car insurance don't hope that they drive their car into a tree before the expiration date of the policy, right? So you're buying it as protection. You're hoping that you never use. And this is the way to approach this going into earnings. Marketplace seems to be a little bit nervous about Apple, but as usual, most of the pundits are saying we're long-term bullish on Apple. There's some out there that are skeptical about it. But with that said, this gives us some protection just for this earnings report, and then allows us to, sleep well at night. Well, Apple is announcing earnings on a Thursday. All right. So that's going to be it for the paper trade. And I don't see any questions inside the YouTube channel. So with that said, this Friday, it's going to be an education Friday. We're going to be talking about, we've done this once before with Delta. So we're going to look at Delta's best friend, Gamma. We're going to talk how they're interrelated. So it's going to be a very good show using real-time numbers and talking about these Greeks in a very layman's fashion. And then we're going to come back on Monday and we'll look at what happened with MRO and we'll look at what happened on Apple. So this next time that I will be live with you will be this coming up Monday at 11 a.m. Eastern time. And I hope to see you then. Please click subscribe, ring the bell on the YouTube platform. Make sure you get all the alerts for Options Guy TV and pound that thumbs up. That really helps us out. So thanks for coming, and we'll see you Monday.